Hey, what's up? In this video, I want to talk about whether short selling should be banned as a trading practice. So, what is the argument in favor of banning short selling? Well, short selling is commonly blamed for market downturns, though this blame may be somewhat misplaced since the cause of market downturn, or bear market, really only requires enough fear or loss of confidence in the stocks that investors own to cause them to progressively sell shares at lower and lower prices. And ultimately, this comes back to supply and demand. If more people want to sell than those who want to buy, prices will drop, with or without short selling taking place. So if you look back in history, short selling has been around since the beginning of stock markets in the early 1600s, where one of the first, although temporary short selling bans occurred in the brand new Amsterdam Stock Exchange after a major short seller was suspected of manipulating the stock price of the Dutch East India Company, who were basically a bunch of assholes involved in major slave trading. So it's actually a shame short sellers couldn't drive the price of their stock into oblivion. Now, later in history, the British government tried banning short selling following the aftermath of the South Sea Bubble, which occurred in 1720. The South Sea Bubble was the focus of the South Sea Company, which was founded in 1711. And basically, they were also a bunch of assholes involved in the business of trading slaves with Spanish America. Now, back to 1720, there was a surge in the stock's price following a proposal that it made to the British Parliament suggesting that they take over the national debt and also on the prospect of the company expanding their business. Long story short, scammers got involved, people found out about it, a panic ensued, the stock bubble popped, short sellers jumped on board, the price crashed, and then damn near took down the British government with it. And sadly, that business didn't go out of business until 1853. Now, more recently in history, at the peak of the 2008 financial crisis, short selling was temporarily banned across North America and Europe to help prevent further market meltdown and in hopes of restoring the economy and investor confidence. And even much more recently, short selling was banned across many European countries due to the pandemic, along with Korea, for very much the same reason as the 2008 financial crisis. So, as you can see, there have been attempts to ban short selling because of its association with stock market sell-offs and financial crises. However, these bans are usually removed since short selling actually plays a pretty damn important role in the market and in many ways can be a good thing. Alright, well, how is short selling a good thing? Well, let's talk about it. So, one thing short selling does is it protects against overinflated prices beyond what are currently reasonable, like what we saw with the Bitcoin bubble back in 2017, though prices did eventually recover and surpass it. Now, normally, stock prices oscillate or move up and down around their fair value, which is another way of saying what a stock's price should be given its current business situation. And as a business improves, its fair value will rise, as should its stock price. When the price of a stock starts to really exceed its fair value, short sellers will step in and drive the price back down to or even below that fair value. This is actually a good thing for buyers because now they have an opportunity to buy a stock that they really like for less, giving them more room for those shares to go up in value. In addition, because of the nature of shorting, short sellers can actually help put fraudulent companies out of business, which protects consumers. And this was the case with Enron when a prominent short seller exposed their sketchy accounting practices, crashed their stock, and put those executives in jail. Short selling also provides liquidity. For buyers to buy stock, they need someone to sell that stock to them. The less sellers there are, the more likely it is that buyers will be forced to buy shares at a higher price because those who are selling will want to sell their shares for more, right? The more sellers there are, the more competition there is amongst them, and the lower the ask price is, which is where sellers want to sell at, compared to the bid, which is where buyers want to buy at. Where would you want to buy GameStop at? Buy low, sell high, right? Shorting also provides additional opportunity for you to make money. Now, normally you'd buy stocks to make a profit, but what happens during a prolonged bear market, such as the 3-year bear market following the 2000 dot-com bubble, right? Stocks lost value for 3 straight years. If you only bought stocks, you'd likely have lost money until the market recovered. Or during the financial crisis, which lasted from November 2007 until February of 2009. Another way shorting is beneficial is that it can be used to protect your account against falling prices. So, for example, if you own shares of a company, you can buy a put option during a sell-off, which will increase in value while the shares decrease in value. And this is called hedging, or protecting your equity from a price movement that goes against you. The put option could then be sold and closed out for a profit while the value of the shares begins to rise again. And this is actually an options trading strategy called a protective put. Now, I am not suggesting you trade options, this is just an example. And if you do want to trade options, make sure you know exactly what you're doing, because while you can make a lot of money, you can also lose all your money very quickly. And as we've seen with GameStop, short selling can actually be to the direct benefit of buyers if a stock is significantly oversold or overshorted, leading to what is called a short squeeze, which is essentially where buying suddenly overpowers selling, forcing short sellers to exit their positions, which further adds more buying, creating a huge surge in prices. Without Wall Street short sellers overextending themselves, Wall Street bets wouldn't have been able to take advantage of that and turn everyday people into millionaires. Now, where short selling becomes a problem is when it's abused, such as in naked short selling, or when short sellers excessively gang up on a stock, causing it to crash, which is referred to as a bear raid. To protect against this, in 1938, the SEC enacted the uptick rule, which only allowed short sellers to short when the stock price moved upwards, which was later repealed in 2007. Then, as of 2010, the alternative uptick rule, which is also called short selling restriction or Rule 201, took effect, which also requires short sellers to short on an uptick, but only comes into effect if a stock has dropped more than 10% in a day. So what do you think? Should shorting be completely banned? Leave a comment with your thoughts about it below.